If you know anything about me, which you likely don't since I'm brand new here on YouTube, you know that I've been putting my money in index funds for years. By the way, if you think underdogs deserve a shot, hit the like and subscribe buttons below. It'll teach the YouTube algorithm that newbies matter too. I haven't actually been index fund investing for that many years, just since I graduated with my Master of Business Administration in 2016. And got a job that paid more than peanuts. Before then, I was broke and in school. I think many of us have been there. Don't worry, you won't need a business degree to understand or put the information I'm about to share to good use. That fancy piece of paper isn't all that it's cracked up to be, and most of what I've learned is self-taught anyway. But the degree did give me some background information and financial knowledge, and I hope I can pass on some useful tidbits to you. Okay, back to the topic at hand. Index funds offer a safe way to invest your hard-earned money. This is due to the principle of diversification. When you own small amounts of ownership in many different companies, there's very little risk that they're all going to fail at the same time. And this protects against eggs in one basket syndrome. Let me give you an example. Let's say that it's the early 2000s and you really like movies and you go to Blockbuster Video every weekend. Wait, it's not a DVD. It's literally the only disc I can find in my house. Maybe you were a kid at the time and you had just discovered Star Wars and you could not wait to get your hands on the new movies and watch them over and over again. Maybe you even love Jar Jar Binks and his annoying voice and weird ears. I don't know what you're into. So then, when you got a little bit of money for Christmas, you decided that since you love movies and everybody you know loves movies too, Blockbuster must be a great investment. So you convince your parents to help you set up an account and you put all your Christmas money into Blockbuster Video. Fast forward a few years later and the share price comes crashing down. You've lost every penny of your investment, or close to it, and you vow to never put money in the market again. Does some version of this story sound familiar to you? My guess is probably it does, minus the weird Jar Jar Binks part. Why did I include that anyway? Let's talk about diversification. The question is, how do you protect yourself against companies becoming obsolete or just failing to perform as well as you wish they would? One answer is to research companies all day, every day, watch for shifts in the market, and learn to successfully pick winners and losers. But as it turns out, not only is this really time consuming, but most people, even institutional investors who do it full time, fail to consistently outperform the market average. Even if we had enough time and didn't have the responsibilities, lives, and jobs that we do, stock picking is really just not a great option for most of us. The other answer is to buy index funds and just take a nap. That's really all there is to it. You see, when you buy an index fund, you're essentially buying a small position in dozens, hundreds, or even thousands of companies, depending on which fund you choose. For example, one of my favorite index funds that I recommend to almost everyone is Vanguard's VTSAX, or ticker symbol VTI if you'd prefer to buy the exchange-traded fund equivalent, which holds 3,576 companies as of my last check. An algorithm is used to pick which companies are held, and they're constantly changing. The goal of the fund is just to mimic or represent the performance of the entire United States stock market. This way, if one company does crash and burn, there are over 3,500 other companies which didn't fail to boost you back up. And that's the principle of diversification in action. Almost all savvy investors take advantage of it to some extent. As a side note, this type of diversification used to be really hard. Prior to 1975, when John Bogle, the founder of Vanguard, started the first index fund, you had to buy into mutual funds with really high management fees or buy lots of individual stocks yourself. It was tough. Also, since the internet and easy-to-use investing platforms like Robinhood didn't yet exist, you had to do it all by hand, keep a paper trail for tax season, and fill out tons of forms. We've come a long way, and thankfully you don't have to deal with that anymore. Now, of course, your upside is limited with index funds. You probably aren't going to receive the Bitcoin-type return of 269% in 2020, but you can also sleep well knowing you won't wake up tomorrow and find that your account has dropped to $0. How much return can you reasonably expect to make from index funds? Historically, the S&P 500 has returned about 10% per year before inflation. So if you buy a broad market-mimicking index fund like Vanguard's VTSAX, Fidelity's FXKAX, or Schwab's SWTSX, or similar, you can expect 7 to 8% annualized returns after accounting for inflation and averaged over multiple years. Now you might be saying, Keena, what about all the people who lost their life savings in the 2007 to 2009 Great Recession? Well, if you were around during that time, or if you were somebody who lost money in a financial crisis, you know how miserable market downturns can be. Personally, I was in high school when the 2008 crisis hit, so it didn't directly impact me, but I do remember seeing the stress on the faces of adults around me at that time. The thing is, I've since come to realize that many people who took losses during that time period didn't have to. Money is often lost in recessions due to psychological factors. That is, when you see the value of your investments fall 30 to 50% more, at least on paper, the natural reaction is to sell and get out of the market before it falls even more. However, if you can muster the courage to hold, your index fund will virtually always bounce back and later go on to achieve new heights, assuming you're well diversified. This is because all recessions come to an end. And when the pessimism leaves the market, companies that were selling far below their intrinsic value come roaring back. And so does the value of your portfolio. There's never been a depression or recession that hasn't come to an end. If the economy didn't bounce back, then you could lose your entire portfolio. But at that point, we would all probably have bigger issues to deal with, like the collapse of the entire US banking and financial system. Seems unlikely to me. And as investors, we can all be relatively confident that the market will bounce back from crises. But it may take more time than we'd like. While the market bounced back from the recent pandemic in a matter of months, the recovery after the Great Recession was much slower. It took nearly 5 years for the market to reach the highs of the pre-crisis era. So we need to be both comfortable knowing that our portfolios might temporarily lose 50% or more of their value, at least on paper, and be financially and emotionally capable to leave the money in until the market has returned to pre-crisis levels, at minimum. I recently stumbled upon a study from JP Morgan that said ordinary investors earned an average 2.3% annualized return over a 20-year period. That's less than inflation. And I know exactly why. Fear drives people to sell at inopportune times during recessions. So only invest money that you can afford to leave untouched for a few years if and when the economy takes a dive next. There are many different types of index funds. The ones I stated earlier are very broad, well diversified, and you can't go wrong with them. There are also funds that invest overseas, in emerging and developing markets, funds that track certain industries like technology, and a lot more. Let me know in the comments if I should do a deep dive on the different types of funds available and the best options to choose. That's it, everyone. I hope this video helped increase your understanding of index funds. Drop any questions that you have below and I'll do my best to get to them. Thanks.